Okay, so we've had an interesting year so far, haven't we? We've had high inflation, price of everything's going up, interest rates are going up, we've got war, the markets are wobbling all over the place, the Aussie dollar's been crashing. We're going to hear this morning and over the rest of the day from portfolio managers, consultants who are handling these issues day to day and putting portfolios together and finding out a little bit on how they handle these issues. I also wanted to point out before we get going that our final speaker today represents $600 billion of funds under management. It's giving advice on $600 billion. So Toby tells us his estimate is that the total managed account market is probably $150 billion. So that gives you a comparison. So definitely worth hanging around for our final speaker, and certainly some of the ones before that are worth listening to as well. Now, before we get underway with our first session, a couple of housekeeping things. First of all, there is free Wi-Fi if you haven't found it yet. You can find it quite easily. It's just Arts Centre free Wi-Fi, and you can connect to that. There's no password or anything. And also, there is a QR code on the papers on your table there. That'll give you all the conference material. Every presentation is in there, and there's also additional material provided by some of the speakers and bios of all the presenters today. So that's the Wi-Fi. I will now invite the speakers and the panel for our first session up to the stage, please. Our first session is looking at inflation. I mean, RBA is talking about inflation here potentially hitting as much as 8% by the end of the year. They've always done that. They've done that and more already in the US and in other countries. The question, of course, is that it? Has inflation peaked? Is it going to get better from here, or are we going to see worse and continued rate hikes? Our first speaker today is Sivapalan from Janus Henderson, and Jay will then be joined on a panel moderated by Toby. And we have Hugh from Atlas, Kieran Rooney from Evergreen, and Chamath Silva from BetaShares. So please welcome Jay.
Thanks, David, and thank you, Toby, for the invitation to join you to speak about inflation this morning. And good morning to everyone. Yesterday morning, when I was heading off just before starting my day, I headed down to the local coffee shop and I walked up to the counter and I was just looking at the board and the coffee of my choice, I'm a Melburnian, so I love my coffee. Coffee of my choice was $5.90. I just stood back a little bit and I thought, gee, that's expensive. That's nothing like what I was paying pre-pandemic and a year or two ago. So of course, it's a non-discretionary item for me, so I stepped up and I paid the $5.90 and got my coffee. But then this morning coming in here, I thought, you know what, there's free coffee just out the back here. Well, I might go the free coffee. So as David alluded to, very interesting times, and inflation is the issue of the day today. So what I'd like to do is really give some opening remarks around inflation, touch on both the structural and cyclical aspects of inflation, and then we'll get into a discussion about what it really means for portfolio construction, asset allocation, and ultimately your clients' investments. So let me just start with some comments about the more secular aspects of inflation. The world has changed. I think, all of us through our careers have been fortunate to enjoy a pretty steady state over the last 3 decades or so. But the world has changed, and let me just touch on what has changed. Firstly, effectively since the early 1980s, we've had a well understood trade arrangement between the East and the West, principally the consumer of the US and Europe, and the factory or the manufacturing hub of China and broader Asia, as well as Latin America. Now, for a variety of reasons, I think it's fair to say that those relationships are changing, and as a result, those big trade flows that we've seen that has allowed cheaper provision of products and services. That includes, outsourcing to places like India and Vietnam and Thailand. That is all going to be shaken up as we move forward. Why? clearly it is for national security interests as national resilience interests as well. Now, what does that mean for prices of goods and services over the coming decade or two? It means that it's going to be a bit more expensive than it was that we've experienced over the last 3 decades. Now, it doesn't necessarily suddenly mean we are going to de-globalise. And in fact, our view is that we're not going from globalisation to de-globalisation, but rather moving towards different trading blocks. So that's the democratic West, trading with like-minded partners, and then the East perhaps trading with, or the most socialist countries trading with their like-minded partners. With the exception of raw resources, and this is where Australia comes into play. Because for Australia, we are very strong, very efficient at raw minerals and resources, and a lot of those resources are necessary for the future of the world. That brings me to the next point, and that is energy transition. I won't go into a lot of detail on this, but other than to say that Australia will continue to be a benefactor, in our opinion, in terms of all the minerals that are required to electrify the world. But that will require significant investment and significant spending, and that will come with it some inflation and higher prices. And the last one, which I believe the next session is going to elaborate on, so I'll just really touch on it, and that is geopolitics. So there is this notion, and you'll read in the Fin Review and lots of other media, about nationalisation. So what nationalisation means is that you're going from an open economy back to closed economies. We would argue that that's not the case, but rather economies want to build in resilience around their healthcare sector, around cyber security, and a whole range of other areas. And that will require some onshoring of certain services and goods, which will also put some pressure on inflation. So at a high level, secularly, we believe inflation will be higher in the next decade than the decade that we've just passed. But that said, how much higher? We're probably talking in the order of 0.5 to 1.5% higher, not 5 or 6% higher. So then we need to talk about what are the cyclical components of inflation and the period that we're entering and dealing with at the moment. So what's been the starting point for everything that we're experiencing? Obviously, and I'll touch on this in a moment, but we've had a 100-year low in bond yields, manufactured from really excessive use of unconventional policy. Here in Australia, in other countries like the US, I think it's 220-year low in bond yields, and in Europe, 330-year low in bond yields. And then, of course, we had a once-in-a-century pandemic shock, where effectively the economies went from a running or jogging state to a frozen state, and then back to sprinting, trying to catch up. So a lot of the policy that we've seen in the last 2 or 3 years hasn't just been business as usual, it's been designed to overdo it because the alternatives assessed by the policymakers was too poor. Now, of course, you've got to throw in everything that's going on from a war and the energy crisis that Europe is facing as an example, and we're seeing inflation not seen in decades. And I think when you think about Australia, and we'll certainly get into this discussion, inflation and the cyclical component of inflation generally naturally resolves itself. But it's the second and third round effects that can linger on for a little while. So I'll give you an example. If we think about Australia and housing costs have come down because obviously house prices are coming down, but rents are starting to go up, and we've been underbuilding in the last couple of years, and new projects in the pipeline have been materially low, and net migration, in particular the student population, but also the skilled workers, is starting to shoot right up in our data that we're collecting. So in the next 12 months, we will be back to bringing some 300,000 net migrants into the country, and we won't necessarily have the housing to offer that. So rents will have a 2-3 year spike in terms of inflation. So let's talk about inflation. What has been the longer term history and experience in inflation? If you have a look at this chart, what you see here is that inflation generally has been in that 2 to 3% band, with one big aberration, and that is the late 70s and into the early 80s. And I strongly use the word aberration because if you look at this chart, this is Australian data as far back as we have, but there's international data for about 100 years plus. What you find is that even the period leading up to the Great Depression, through World War I, World War II, and then into the 50s, yes, inflation sort of goes up and down, but generally resolves itself. And that's no more complex than supply and demand. And so this time around, whilst we've got inflation starting to pick up, and this is rolling 10-year inflation, I think it's fair to say that the cyclical part should resolve itself. Now, we all know that shipping costs and containers and semiconductors and all the things that we were worried about a year ago, those prices have come down materially and continue to come down. What we're dealing with now is the second order impacts. Now, there is a strong relationship, as you know, between inflation and central bank policy and risk-free yields. What I've got here is a relatively short-term history of US 10-year Treasury yields, which is the discount rate, the ultimate discount rate that goes into the valuation of all asset classes, be it equities, property, fixed interest, and even high yield. Now, we've got data that goes back a lot further, but unfortunately, for compliance reasons, I wasn't able to put together a chart. But nevertheless, that little green circle that you can see on the far right-hand side really shows a picture that the period that we've exited just now, the last couple of years, it really shows the distortions that central bank policy has had on what is a relatively natural supply-demand, cost of money phenomenon. And 10-year bond yields across the globe over 100 plus years have generally averaged between 4 and 6%. Today we're closer to that 4%. And so that period of aberration in 2020-21, which really started from the GFC when central banks started experimenting with unconventional policy, has led to ultra-low yields, and of course now we're normalising. Just in terms of a forward-looking comment on the Australian economy, and I would say that economies like the US aren't too different, albeit Europe and perhaps Asia is quite different. What we've tried to capture here in one picture, and it's very hard to do on one picture, is essentially our whole economic outlook in terms of policy. So the curved line is economic growth. Where are we today? It's effectively those green words. We are at full employment in most economies. There's still pent-up demand and excess savings. So to deal with the problem of today, and if you're a central bank, you generally have, and in Australia's case, 3 mandates. In other countries, slightly different. But essentially, it's full employment. You can put a big tick next to that. Price stability, which basically means inflation. That's a big cross. And then financial stability, which to date is still a tick in Australia's case. So the RBA is raising rates, and of course, it was very much front-end loaded. And it's designed to slow down, and there's a couple of reasons why in Australia they've moved from 50 basis point increments to 25. It's got a lot to do with household debt and the situation in Australia relative to places like the US, which is quite different. Just in terms of inflation, the wages inflation picture in Australia, which is backward looking, is about 2.6% wages inflation to date, year on year. In the US, it's 4.6%, so more than double. So they've got a much bigger problem than we do. And with what I just mentioned about the labour coming in over the next year, we should be able to navigate a pretty good path. But you can see how the RBA policy translates. We expect them to peak in terms of cash rates at about 3.1 to 3.3%. And then the unemployment rate, which has continuously been coming down, should start flattening out and then gradually going back up. And then you can see inflation sticking around for a little bit longer, albeit perhaps, and we'll get into this discussion, perhaps the worst components of inflation has already peaked. So I showed you that really long-term bond yield chart, which is very much the basis of our discussion today, which is risk-free yields. But cyclically and more nearer term, have they peaked? What I've produced here on this chart is the relationship between the RBA cash rate, at least over the last 20 or so years, and the 10-year government bond yield here in Australia. And what we generally find is that bond yields peak well ahead of cash rates peaking. So in other words, bond markets are very much forward-looking, and when the cash rate peaks for that particular cycle, which I've circled, bond markets generally tend to go sideways thereafter or tend to come back down. And we feel that this time around is very much a similar phenomenon, albeit our starting point in terms of the distortion that was created by central banks is much more. But certainly, it would be our view that a lot of the damage in bond markets and the lift in bond yields for now has already been priced in. Of course, it'll remain volatile, but has been priced in. So with that, I might pause and ask Toby to host a session.
Thanks very much, Jay. So if we could just advance one more slide and then we'll... Great, super. All right, well, look, thank you very much, Jay. That was... so the format of today's sessions will be, I've asked each of our fund manager participants, Janus, Henderson in this case with Jay, to sort of frame up the conversation, to frame up the discussion about the particular topic. And what Jay's given us is an excellent explanation of both inflation and its consequence, interest rates. And as Jay mentioned, that's because it underpins every other asset class. So I wanted to set off today's sessions with this view of interest rates. So now I'm going to ask our participants, Hugh Dive from Atlas Asset Management, Chamath Silva from BetaShares, and Kieran Rooney from Evergreen, to talk about their view of inflation and its impact on interest rates. And let's start off, Chamath, with you and BetaShares.
Great. Thanks, Toby, and thanks, Jay, for an excellent overview of both the secular and cyclical factors driving inflation. So I guess inflation affects all of us, but ultimately what really matters, in my view, for investment returns and asset allocation isn't so much inflation per se, but rather how central banks react to it, especially in an inflation targeting regime. The central bank reaction to inflation ultimately determines the baseline real and nominal rates of return that filter through to all asset classes. Now, inflation globally has forced central banks around the world to tighten policy quite aggressively. And the bond market has really had to, I guess, digest a much more aggressive path for future interest rates. And that's resulted in basically historically large drawdowns across bond indices and several bond funds. And this is all in order for central banks to basically manage inflation expectations and keep them anchored. But there is actually a flip side to this repricing across fixed interest that we've seen. And it's been broad-based. It hasn't just been traditional government bonds. It's also been inflation-linked government bonds through much higher real yields on the back of financial conditions tightening. And we've also seen wider credit spreads as corporate bonds have also reacted to the greater macro and policy uncertainty, higher interest rate volatility, as well as just general increase in risk aversion and a deterioration in global liquidity. But this repricing, the silver lining of this repricing is that the baseline rates of return, both nominal and real, on traditional defensive assets, and the safest of defensive assets, that is cash and government bonds, are now better than they've been in several years. And fixed income, as an asset class, for the first time in some time, is now a meaningful source of income and potentially also portfolio diversification. And if you do believe that central banks will have their way in that they will be able to sufficiently destroy nominal demand, which is the main lever they have to pull, then defensive assets are arguably much more attractive relative to growth assets, at least, compared to 12, 18 months ago.
Thanks, Chamath. Kieran, as the sort of representative portfolio manager on this panel, so let's understand how Evergreen are thinking about these issues in the portfolio construction. In your thinking about portfolio construction.
Yeah, look, I'd agree with Chamath's conclusions there. And with respect to inflation, I think there's a few components. I think on the monetary side, and Milton Friedman taught us that inflation is a monetary phenomenon, and when there's too much money creation relative to the productive capacity of the economy, that leads to inflation. So as Chamath quite rightly pointed out, and we're all aware of it, central banks have been tightening liquidity quite extraordinarily. But the majority of liquidity provision to the economy is actually from the private sector, and we can also see broader monetary aggregates that include that, such as M2 rolling over. Is that working? Yeah. We can see broader monetary aggregates such as M2 rolling over, but then also more sophisticated measures that also capture the very large and deep wholesale funding markets that we have today are also rolling over quite starkly. So the liquidity cycle is quite tight, and you can see that in commodity markets where commodities have come down quite a lot in what is a supply-constrained market. On the demand side, I think Jay made some good anecdotes there, where clearly the fiscal impulse is turning down, so the fiscal support from the pandemic has been withdrawn. I think discretionary spend is going to be pressured. I mean, good God, Jay's paying $5.90 for a coffee. I don't think he's going to have much money to spend on much else. And real wages are down. And furthermore, I think there's going to be a negative wealth effect. You guys manage people's retirement nest eggs. In real terms, that's been hammered. And of course, Australia, we've got a very interest rate sensitive housing stock with variable rate loans. I think where it gets interesting for inflation moving forward is on the supply side. There's a panel on geopolitics next. So I won't steal their thunder, but we're clearly in an economic war with China and Russia. And if you read Putin's speeches, he talks about the economy of real assets versus the economy of intangible wealth, the economy of imaginary wealth. And essentially in the West, we've deindustrialized. I mean, the fall of the Berlin Wall brought the largest commodity producer in the world into the global economy. China joined the WTO in 2001. If Russia's on a path to become a pariah state, and we're going to cut that off from the Western world, and we no longer trust China, and we're going to have to reorganise supply chains, that's going to take capital. But the problem is in the West, our capital cycle has been mainly focused on intangible assets. Huge amounts of money is poured into tech. Not much money has poured into the real economy, manufacturing, materials and energy. I know a few guys that used to run BHP, and they freely admit that they wasted billions of dollars in the last commodities boom. They thought it was going to continue forever, and so there was an aversion to spend on capex to produce expand capacity. And furthermore, shareholder activism. I think you remember Paul Singer of Elliott Asset Management became activist on BHP in 2018, essentially pressuring them to return capital to shareholders. And so I'm sure a lot of your clients got very juicy dividends from BHP in the last couple of years on the back of that. But unfortunately, in a period where we have to reorient supply chains, we have to invest in energy production, the cost of capital has risen because of the activities of central banks and so forth. So unfortunately, on a longer run basis, in the attempts to hammer demand now and take pressure off inflation now, we're shooting ourselves in the foot in terms of expanding productive capacity in the years ahead. And when I spoke about this with Hugh last week, he had the very good example of the shale oil producers. I'm not sure if you want to...
Hugh, well, that's... I was going to say that's sort of an excellent segue to Hugh talking... so give us your perspective on the issue of how the rise in interest rates is going to translate into changes in equity assets.
Yeah, thanks very much, Toby. Unlike Jay, great presentation. Up in the sky as a Australian equity portfolio manager running managed accounts, I'm right down in the weeds. So it's changing your stock selection and changing it to more at a company level. So one of the great parts about running a managed account is that unfortunately the clients can see everything. So some of the companies that worked very well over the last 5 to 10 years aren't going to work very well in the future. So one of the biggest things we've seen is the change of the discount rate, so the risk-free rate. So traditionally when you're valuing a company, you use equity risk premium multiplied and then using the risk-free, so the 10-year bond. Jay had a chart that went right down to about 1% or thereabouts in 2020. During that time, if you were using 1%, everything was a buy. I saw one of the big sell-side companies had a $200 price valuation on Afterpay. And that was predicated using a 1% risk-free rate, and I think $160 of that was in the terminal value. Obviously, so that's gone up, and so those sort of long-dated assets are suddenly not that attractive. The second thing we're sort of seeing is what we saw in the August reporting season is companies that can pass on inflation. They've done sort of quite well. So, for example, packaging company...
Coffee vendors, for example.
Coffee vendors, yeah. So, for example, Amcor passing on their inflation, passed on, I think, $1.2 billion in rising resin and aluminium price. Transurban, which many of you use today, and I use a lot in Sydney, every 1st of July, couple of click, it goes up by inflation, no problems there. However, other companies, for example, ASX or Woolworths, what we saw in that August reporting, so they're having a lot of trouble passing on inflation, input prices going up, and so their margins were sort of squeezed. The third thing we're seeing is, with rising rates, is looking at companies' debt. So companies that are sort of high levels of debt, and particularly their tenor of debt. So we're having to sort of reprice. So we're in a little bit of a different situation we were just 2008, where we saw some LPTs effectively finance their operations on credit card debt. So Centro had $2 to $3 billion on 1 year money. So seeing that flow through to companies' sort of bottom lines. And the fourth sort of real thing is the game's sort of changed. So in an environment of sort of rising rates, companies that have a promise of vast sort of profits very much in the future, which may or may not occur, those profits are worth much less than companies that are generating income today and that are able to increase their profits and increase their dividends today. So a key measure we look at when we're reporting every earnings season for our portfolios is, have the companies in aggregate increase their dividends greater than inflation? And that's the key sort of measure we're looking at. So ultimately, we do those high growth sort of concept stocks, sexy stuff, it's going to be more and more out of fashion. And what's going to be more in fashion is companies that can pass on inflation and grow their earnings, particularly grow their dividends greater than inflation, and that's a key sort of measure. So I think the game's sort of changed, working a bit better for my sort of stocks, but what worked for the last 5 years is probably not going to work in the future.
Well, therefore, what does normality look like in the future? What are we? What is the world that we are heading into? Jay?
Yeah, and I think there's been some really good points raised today. For most of the audience and your clients, you're really trying to do two things other than, develop an appropriate financial plan for your clients, really to protect the buying power of your clients' hard-earned savings into the future when we think about inflation. And so most would be focused on something like a CPI plus 3% objective. So if we just think about that for a moment, one of the important things that have really changed, and Chamath could certainly elaborate on this, is real rates. So today, investors can buy inflation-linked bonds as one example. 2040 inflation-linked bond in Australia with a 2% real rate. In other words, whatever inflation is, that particular instrument will pay an additional 2%. Now, that wasn't the case in the last 2, 3, 4 years. And that's really repriced that asset class. And if I give you a couple of other examples, just some practical examples, today we're able to buy National Australia Bank, Woolworths, NBN, university debt, etc., all with yields between 5 and 7%. So if you just sort of reflect on what investors have had to endure in the last 2, 3 years during our TINA environment, you really had to pursue heavily growth assets and also, in some cases, illiquid assets to get that premium to deliver returns when defensive assets and risk-free assets were yielding sub 1% in most cases, in some other cases 1.5%. So from an asset allocation perspective, we think it's more likely that investors will shift back towards a bit more of a traditional 60-40, 70-30 type split rather than 80-20 type growth, defence split.
And I mean, that's an interesting point. I mean, Kieran, in your portfolios, the traditional 60-40 portfolio, and we've seen this in the industry funds as well, has tended to drift up in the growth asset classes. How do you see that playing out?
Yeah, it's interesting. We run simulations on people's portfolios, and obviously, we can put in various assumptions and test if those portfolios are meeting objectives. In the last few years, when inflation was essentially below 2, it's pretty easy for those portfolios to meet their objectives. And I guess the most important thing for your clients is what are their real returns, because that's what they eat. But I think in the last few years, I think people got caught up managing their portfolios in terms of chasing certain benchmarks rather than what are the actual real returns or CPI plus objectives that your clients actually need to have a good retirement or meet their retirement objectives. And in doing that, as Jay kind of referenced, they kind of went up the risk spectrum and particularly took a lot of illiquidity risk. And you mentioned institutional investors like the big super funds and so forth, and we've seen a lot of that occur. But then when you actually have to factor positive, decently positive inflation into your models, a lot of those portfolios that used to easily pass objectives now actually fail on those objectives. And so when you're building a portfolio in today's environment, and I guess going off my opening kind of soliloquy on inflation, the outlook's very uncertain, and it's going to be not a straight line. It's going to be very bumpy. Inflation may moderate and then come back later on. And so in that kind of environment, you need to build a portfolio that's more robust, that takes into account more probabilities in order to be able to achieve its objectives in a wider set of outcomes.
So do we all agree with the point Jay made in his initial comments that secular inflation is now going to be 1 to 1.5% above above the band of 0 to 2%? I mean,
yeah. So
well, you agree with yourself,
yeah,
probably,
no. I was just going to say, really the point in reference I was making is relative to the last decade, we expect inflation on average over the next decade to be about 1.5% higher. Yeah.
Than the band, or than the sort of RBA's target band, or than we've experienced?
Than we've experienced. So I think in the last decade, in particular prior to COVID, but after the GFC, we've struggled to keep within the RBA target band. In fact, we were very much at the bottom of the RBA target band. Perhaps the next decade we're at the upper half or towards the upper end.
What about the others? I mean, do you share that view that we're heading towards the sort of upper bound of the target rate?
So I might just quickly jump in here, and I think there are many good reasons why inflation pressures might rise on a secular basis. But I think whether that translates to higher realised inflation, I think really depends on what central banks do. Will they maintain their 2 to 3% inflation targets? If so, then secular inflation pressures might demand higher neutral real rates and a more aggressive or a tighter policy stance for a longer period of time. So I think it's important to maybe distinguish between inflation pressures and what might actually be realised.
So does that mean that we may be in this kind of continuing tension between interest rates? No, that's a question. How will that play out then in sort of interest rates that, for example, corporate issuers have to offer, or that governments offer?
I think we're just moving to a more normalised environment. I mean, looking at Jay's slides, and I think when we were preparing for this, I found one of those great Homer and so sort of 4,000 years of interest rates. What we've seen is unprecedented in human commerce the last couple of years. So we're heading back to a more normalised rate. So savers are going to be rewarded. So we've heard that term financial repression. I'm sure a lot of your clients, particularly sort of retirement clients that are getting 1% or 0.5% effectively on the pension line with $1 million in a term deposit. We're heading back to a more normalised environment of pricing risk.
So what does that mean for advisors in terms of the conversations they have with both their portfolio consultants and their clients?
I think one of the things worthwhile having as a discussion point is all the things that clients and investors have experienced and seen in the last 2 or 3 years, which is, as we know, a lot of the industry funds have really spoken a lot about the illiquid assets or the unlisted assets. I heard a chief investment officer recently really spell it out quite well that, look, to move from public markets to private markets, whether it's equities or fixed interest, you generally need a 2% premium in returns. And today, in many cases, that's either zero or negative. So in other words, why would you do that? So I think that's one of the conversation pieces about the value in public markets today relative to unlisted assets, which is probably not as clear. And then the other, which we discussed, is really then going back to the building blocks of portfolio construction, starting off with the defensive side, which is much more attractively placed today, and then building the growth assets that are a little bit more certain, where stock selection is much more important today in an uncertain world.
Yeah, I'd echo that. Stock selection is much more important. You can't just buy the index because now you've got a new thing, inflation. And do the companies you own, can they pass that on? Can they increase their dividends greater than CPI? I think you could probably ignore that for the last sort of couple of years. Now that's something you've got to think about. And are those dividends increasing above CPI and maintaining your purchasing power?
So I might just add to that now. Hugh made a good point about quality companies with pricing power, but I'd argue that the idea of quality coming back spans across all asset classes. So even within equities, you could argue that maybe there should be a trend towards switching away from hyper growth towards quality, but within fixed income, now high quality defensive assets are providing a meaningful source of income. So there should be a trend maybe towards increasing.
So does this mean that sort of old saying, Warren Buffett, I think, that when the tide goes out, you see who's been swimming without shorts, that we're actually going to see as interest rates rise, which companies haven't had the necessary.
And particularly companies that haven't taken this opportunity to get their debt house in order. So companies with far too much short-term debt, far too much highly geared, they'll be the ones that will suffer in the next sort of couple of years.
And so from a portfolio construction point of view, how does that change then both your asset allocation and manager selection? So the types of managers that you want to have in a portfolio. Kieran, what's it meant from Evergreen's point of view?
Well, we've always tried to maintain style neutrality, even over the last decade. It's something that we've always paid attention to. But I mean, and everyone splits it up into value and growth, but they're both broad churches. There's lots of different types of value companies and lots of different types of growth companies. Like, I'd say like growth companies that you'd find in like the ARC fund are really different to like growth companies like, say, an ASML, for example, which cash flows really well, can reinvest in the business and immediately get compounded returns on that cash. So I think stable compounders in terms of growth companies are still going to be okay. And, a lot of those have come down quite a lot. Maybe there's still to go, who knows, but, it's starting to get some attractive levels there. But obviously in a high rating environment, the outperformance of growth relative to value probably won't continue, and so you do want an allocation to value equities there. You do have to be careful because, as I mentioned before, the liquidity cycle is turning down. Even in a supply constrained world, it's hit commodities, so cyclical value can still get hit. But there's lots of quality value companies out there that have strong market positions and return a lot of cash to shareholders. But in terms of what Chamath and Jay have been saying too, in terms of increasing the quality of your portfolio, not just on the equity side, but on the fixed income side. And we talked a little bit about people chasing the illiquidity premium and so forth. A really easy example of that I think a lot of people understand is that a lot of people have chased property finance the last few years. And that was a great trade. I was involved in that trade. In 2014, APRA came out and changed the banking regulations and risk weights, so banks couldn't make certain corporate loans that they used to, or they could, but the IRRs on those loans for them on their balance sheets wasn't anywhere as near as attractive as a resi loan. And so like in 2015, you could you could like lend like money on like a $10 or $20 million eastern suburb Sydney property and get a 10% return at a 20% LVR. Like, it was just really astonishing, the pricing you would get, and I'd call that really low risk. Since then, you know, obviously capital has chased that, competition's increased, rates have come down, LVRs have gone up, and, you know, on a 60 or 70% LVR, you're probably getting, you know, 6%, if that. And so public bond markets, I think, have priced in a whole lot more than the private credit markets. And so I think now is a really good opportunity to increase the quality of your credit portfolio, because now you're actually getting returns on your credit portfolio. It's not risk-free, it's not return-free risk anymore. You're actually getting a positive return. And so we're actually seeing some good opportunities in that space as well.
Yeah. So what does that mean? I mean, as a professional bond manager, Jay, what does that mean for you in the way you think about opportunities for the portfolio?
Yeah, so what we've seen, and if I just focus and continue on with the theme of the corporate bond market or credit, what we've seen is that the areas that were best supported or most supported by policy, so think in Australia's context, the term funding facility that really helped our banks out, and a whole range of other policies. As those unwound, we've found credit spreads widen and go up. So the cost of borrowing for banks have gone up quite considerably. On the flip side, for us as investors on behalf of our clients' monies, it's a terrific opportunity to buy effectively, you know, government-protected industries at quite good valuations in that high-quality end. So if I use credit quality, you know, we've been targeting the AAA and AA parts of the market much more than the BBB part of the market, where the repricing is still occurring. And then if we go a little bit further into high yield, emerging market debt and loans, it's arguable that some of those pockets still have further repricing to go. And, you know, we've all heard the term zombie companies, especially abroad. I think it's fair to say that there is probably, and these are just rough numbers, so please take it with a grain of salt, but there's probably 10 to 15% of all companies in the US that wouldn't exist in a materially higher rate structure, especially if the end consumer isn't there, which is what the Fed is trying to do. It's trying to slow down the end consumer demand. And so 2023 is really going to be interesting for those companies. The other area, and I think Hugh sort of touched on it from an equity perspective, but from a fixed interest perspective we've been focusing on is those companies and issuers with hard assets, whether it's core infrastructure like airports, universities which have terrific property assets, toll roads, seaports, so Port of Melbourne, Port of Brisbane. These are terrific assets that have cash flows that are either directly or indirectly tied to inflation, but also hard assets if things become more challenging.
Right. Now, look, of course, we'd welcome questions from the floor. So if you have particular questions or particular areas that you'd like us to talk about, just pop your hand up. Yes, over here. Yeah.
Thanks. We've heard a lot about prices and the price of coffee and so on. We haven't heard much about wages. I just wonder to what extent you all think that is a big risk factor for inflation. I mean, before the election, we heard about Albanese was saying people on the low wages should definitely get a real wage rise, and with inflation heading to 8%, is there a danger on that front?
So I guess it's worth casting our mind back to the pre-COVID period when the RBA was really struggling to generate broad-based inflation, and their view was that for inflation to be sustained, that's right. When inflation to sustainably be in that 2 to 3% target band, wages growth would have to be 3% or greater. Now, obviously, wages growth has accelerated, at least relative to our recent history, but the pressures aren't anywhere near as acute as what we're seeing in the US. And I guess if, you know, Jay's point about it, you know, if net migration does pick up, then that could take some of the tightness out of the domestic labour market.
Yep.
In the August season, we did see some impact of wages, rising wages, particularly on both ASX and Woolworths. They were both impacted by by rising wages. What we're also seeing in the miners is much more use of mechanisation, so the driverless trains, the driverless trucks, because they're very concerned that those wages are going to be much higher in the future.
I know sort of anecdotal evidence like Jay's $5.90 coffee is, my son is a chef, and whereas going pre-COVID he was working a 60 to 70 hour week for $65,000. Now he's on about 95,000. Now he's had a promotion, but they are 3 chefs short in their restaurant out of a notional team of 11. So he's still working a 70-hour week, but the wages have gone up. Now, of course, immigration, because of course it was the French and Italian chefs who went home. As they start to come back, presumably we'll see some some moderating of his overtime rate, apart from anything else.
Yeah, I think in the near term, there's no doubt that there are wages pressures in certain segments and sectors, and hospitality is one of them. I think especially us here in Melbourne, we were tired of eating our own 2-minute noodles during lockdown, so we all want to go out and eat and obviously pay for $5.90, coffees at the expense of life insurance, which is probably the other thing that we'll take out. But I think the important thing to, I guess, understand is where Australia is in the global context. So, as I said before, 2.6% wages inflation, which is backward-looking, admittedly. It's not extremely high, in particular when you're thinking about very hot labour markets like the US. Now, with the current government, and we'll have the budget coming out shortly, there probably will be some measures to ease cost of living pressures, and part of that perhaps will be wage rises. So this is what I was talking about earlier about the second and third round effects that can mean that inflation sticks around for a while, but that doesn't mean the upward pressure is as strong.
Okay. So let's wrap up then by just going back over the key question for this, the key underlying question for this session, which is what does this mean then for portfolio constructions for the typical client talking to their advisor? So, Kieran, let's start with you.
What does it mean for the typical client?
Yeah. So what does this all mean for building portfolios, talking to advisors, helping them talk to their clients?
Yeah. So I guess when you're talking to your clients, you really have to just figure out what their objectives are and plan properly in what is an increasingly uncertain world, because I don't think anyone on this panel pretends to have all the answers, because who else, has anyone else in this room managed portfolios coming out of a once-in-100-year pandemic with unprecedented geopolitical tensions now boiling over? I don't think so. So I think you have to highlight to your clients the uncertainty, really plan in your conversations with them what their objectives are and plan accordingly. But when you're managing at the model level, I think that you have to be laser focused on your portfolio objectives, and it's usually a CPI plus objective. I think because CPI didn't exist the last few years, people just kind of dismissed it, and like I said before, they were focusing on these indexes or these benchmarks and chasing that. I think you shouldn't be too focused on benchmarks that don't matter to your clients. You have to be willing to underperform certain indexes or benchmarks to really make sure you're managing to those CPI plus objectives properly, and that involves having a much more diversified portfolio that takes in a high degree of probabilities moving forward.
Hugh, what does it mean from your perspective?
Well, as a sort of active manager, I welcome this. This is a good period. The style of quality is working quite well. The key message we're putting out to our clients is look at the sort of aggregate weighted increase in dividends, and is that greater than CPI? And that's sort of the key message we've been going out, and that's been resonating quite well. So and is that increasing above CPI? And that's a sort of measure of success in each sort of reporting season, that the companies you own are growing their profits and giving those returns to the underlying investors in the managed accounts, and they're growing better than inflation. And that's a message is doing well.
Chamath?
So just coming back to Jay's example of the CPI plus 3%, hurdle, you can now achieve that hurdle with a much more defensive allocation. You no longer need to take on as much credit risk, as much liquidity risk, nor do you need to really stretch out that much into unlisted and private assets. You're now earning around 300 basis points more on cash, on government bonds, on inflation-linked government bonds, and maybe a little bit higher on corporate bonds compared to 12 months ago. So, it is now an opportunity maybe to de-risk portfolios, to improve the quality of portfolios, as well as maybe to improve the overall liquidity profile of portfolios.
And Jay, from your perspective?
Yeah, look, I'll just echo my peers' comments here. I think for much of the audience here, the last few years has been a fruitful period for investors, but it's been with some level of discomfort deep down in your stomach that you've had to take risks that you ordinarily wouldn't take, whether it's illiquid markets, whether it's further down in credit quality and credit products and fixed interest, or strong style biases in equities and other areas. The period ahead, I would like to leave in a positive note that perhaps higher quality, simpler asset allocation, a bit of going back to the past will actually serve investors well. And to Chamath's point, you don't necessarily need to take as much risk on a forward-looking basis, albeit near term, there's a bit of volatility still to be had. The other thing I just want to touch on very briefly as a conclusion is a lot of the changes that we spoke about, and in particular the secular changes that I mentioned around global trade, around national resilience, around transition to climate risks, etc., they're going to create phenomenal investment opportunities for your clients. And some of them are going to be government-backed. So we talk about higher quality de-risking portfolios. There's nothing better than buying an investment that pays a market commensurate rate of return that is partly government-backed.
Thank you. So are there any final questions from the floor for our panel? Look, please join with me in thanking Jay, Chamath, Hugh and Kieran for a really interesting session to kick us off.